So welcome. So here we are to revise our lovey-dovey Index 20. As I said, I will upload this revision on your YouTube also for future reference. So if you want to download the board notes, so you can find it on my Telegram channel. Okay. And if you're watching the revision on YouTube, don't forget to subscribe. Okay. Chalo. Anyways, so let's start the revision quickly. In Acha, this is going to be in 100% English. Okay. So let's start the revision of Index 20 in 3, 2, 1 and go. First of all, the name of the index 20, accounting for government grant and disclosure of government assistance. How many points are there? Total there are 6 pointers. First is meaning. What is the meaning of government grant? So the meaning and everything is very simple. It is nothing but the assistance provided by government in return for any compliance with certain conditions. That means the government will give you some assistance in the form of monetary or non-monetary grant and expect some conditions to be fulfilled from your end. Okay. Then exclusion from accounting of government grant. Certain items are given. That means the government grant, if it is in the form of this nature, you need not account for it. Just give it a reading. Okay. Then the third part is recognition. When do we recognize a government grant? You will recognize a government grant only when you have a reasonable assurance of two things. That whatever conditions are attached to the grant, there is a reasonable assurance that you will comply with the conditions, and there should be a reasonable assurance that grant will be received. Why this is given? As I said, do you remember I said sometimes the government might just give fake promises and you internally know that you will not receive the grant. So do not book the grant. So you will book the grant only when you have a reasonable assurance. This does not mean that book only when the cash is received. No, you will book when you have a reasonable assurance that you will receive the money or whatever asset you are going to receive. Anyways, then the next point is accounting for government grant. Do you remember I made a chart for you? Quickly, let's start revising each and every point of it. Accounting for government grant. The government grant can be of two types. It can be a monetary grant. It can be a non-monetary grant. If it is a non-monetary grant, what is the meaning of non-monetary grant? That means you are not receiving money from government. Government is giving you any asset for free. So either it can give you a depreciable asset or it can give you a non-depreciable asset for free. So let's say government gives you a depreciable asset for free. So how to do the accounting of this? We have two methods. Either record the asset and grant at nominal value. Okay, or method number 2, either record the asset and grant at fair value. Let's say for example I had a machine which had a fair value of 10 crore. So I will record the machine and grant both at 10 crore. Machine to DGG, deferred government grant. Why deferred government grant? Because grant, even if you receive on day 1, it is of 5 years. Why? Because the life of the asset is 5 years. You will get the benefit over 5 years. So we booked machine to DGG 10 crore. Now this machine will get depreciated over a period of 5 years. And what to do with this DGG? You will transfer it to profit and loss over the period of depreciation or over the period of life of the asset. So in the same ratio you are depreciating, in that same ratio you will transfer DGG to profit and loss, right? Okay, so we have two methods for a depreciable asset: recorded nominal value or recorded fair value. Acha. What if you received a non-monetary grant for a non-depreciable asset? In that case, again we have two methods. Acha, before proceeding, in balance sheet estimate, do remember when you are recording at fair value, the DGG and machine will be shown separately. It cannot be netted off. In P&L, the related expense and related income, you can show separately also, or you can net them off and show also. That is allowed. Achha, now we can proceed. Let's say, for example, you received a non-monetary grant for a non-depreciable asset. In that case also, we have two methods. Method number 1, recorded nominal value. So you will record the land and government grant at 1 rupee, 10 rupee, 100 rupees. Method number 2, you will record at fair value. Right? Now, here when you recorded fair value, you will record the land to DGG at 10 crore. Unlike depreciable asset, here land is not getting depreciated. So now the question comes, in what ratio this DGG will be transferred to profit and loss? Because in case of depreciable asset, we were transferring DGG to profit and loss over the life of the asset. What about in case of non-depreciable asset? So the treatment of DGG in case of non-depreciable asset depends on the nature of grant. You will have to check whether the grant is unconditional or conditional. If the grant is unconditional, full grant will be transferred to profit and loss on day 1 itself. Unconditional means no conditions are attached to the grant. And if the grant is conditional, in that case, you will transfer the government grant over the period of conditions. Let's say the conditions are of 5 years. So you will transfer the grant over a period of 5 years. Simple. Let's proceed. This was non-monetary grant. Okay, simple. Now let's discuss about monetary grant. Monetary grant means government gave you the grant in cash format. Okay, so it can be for a depreciable asset, it can be for a non-depreciable asset, or it can also be to reimburse any expenditure incurred. So let's say for example you received a grant for a depreciable asset. What to do now? Because let's say example you had you bought a machine for 10 crore, you got a grant of only 3 crore. So there is no concept of nominal value here because you are not receiving the full grant. You are receiving only partial grant for the asset. So here there are two methods again. First method is recording the asset at net of grant. That means you bought the asset at 10 CR, you reimbursed 3 CR. So that means the net cost for you is 7 CR. So whatever grant you get, you will adjust from the cost of the asset. That is method number 1. So this is the entry, and the net value you will record machine of 7 CR, and future depreciation will also be charged on 7 CR. Because you adjusted the government grant directly from the cost of the asset, no further treatment is required for government grant. Okay. The second method is you can record both the asset and the grant at fair value. In this case, again, if you recorded fair value, machine recorded separately at 10 CR, government grant in the form of DGG recorded at 3 CR. What to do with this 3 CR? In the ratio of depreciation, you will transfer DGG to profit and loss. Simple. Okay. What if there is a monetary grant for a non-depreciable asset? Let's say you bought a land for 10 CR, government reimbursed 3 CR. Now what to do? Again, two methods. Method number 1, you can net the government grant from the cost of the asset. Method number 2, record both at fair value. Record the land at fair value, record the DGG at 3 CR. Now, if you are recording DGG at 3 CR, again that problem arises because it is a non-depreciable asset. You will not have the ratio of depreciation. So what to check? Whenever it is a non-depreciable asset, check whether the grant is conditional or unconditional. If it is unconditional, on day 1 itself is go to profit and loss. If it is conditional, in the period of conditions, you will transfer it to profit and loss. Simple. Acha. What if the grant is received for any expenditure incurred? Let's say government is not giving you grant to reimburse a cost of asset. It is giving you grant to reimburse any expenditure. So apply the matching concept here. If the grant is given to you to reimburse expenditure of 1 year, the grant will be transferred to profit loss in 1 year. If the grant is given to you to reimburse the expenditure of 3 years, you will transfer the grant to P&L over 3 years. If the grant is given to you to reimburse the expenditure of past expenditure, if the grant is given to reimburse any past expenditure, or grant is given to give immediate relief, then transfer the grant immediately to profit and loss on day 1 itself. Okay, so this was the accounting of government grant. Next point, the point of refund of government grant. Whenever the grant becomes refundable, how to account for it? So the accounting of refund depends on how did you treat the grant when you received it. So let's say, for example, when the grant was received, you immediately transfer the grant to profit and loss. So the refund will also happen through profit and loss. So when you received, you transfer to P&L. So refund also from P&L. The entry for refund is you have to give the cash money back. So you will say to cash bank and debit the profit and loss. Acha. What if when the grant was received, you transfer to DGG? In that case, when it becomes refundable, you will also refund from DGG only. But it is possible that DGG might not have the full balance. Let's say when you took the grant, DGG was 3 CR. On the date of refund, DGG's balance was only 1.2 CR. So let's say, for example, you are refunding 3 CR. So up to the balance of DGG, you will debit the DGG 1.2 CR. Balancing figure you will debit from profit and loss. That means if on the receipt of government grant, you transfer it to DGG and you were transferring it to profit loss over the period. And if it becomes refundable in between, so the refund first write off full DGG balance and then the balancing figure will transfer to profit and loss. Simple. Acha. What if when you received the grant, you adjusted the cost of the asset? So the refund also will be adjusted from the cost. Like when you received it, you reduced the cost of the asset. Now while refund, you will increase the cost of the asset. As simple as that. Okay, this was the case of refund. The last concept is loan at less than market rate of interest. For this, did you know we discussed a direct question? What was a direct question? Do you remember we discussed illustration number 4? How to account for this? Come, I will just discuss the same with you. So, when you get a loan at less than market rate of interest, this point has a resemblance with Ind AS 109 financial instruments. Why? When the government is giving you a loan at less than market rate of interest, in this case, it is treated like a relationship. The relationship is of government grant, where the government is helping the company, right? So do you remember in financial instruments what we used to do? When there was a relationship of parent subsidiary, when parent was helping subsidiary, the difference was transferred to investment in subsidiary. When the employer was helping the employee, the difference was treated like prepaid employee benefit expense. Similarly, here one question is there. Government gave loan of 50 lakhs at 5% coupon, but the market rate is 12%. Why the government is giving you loan at less than market rate? Because it is giving in the form of government grant. right? So in this case, how to solve this question? So you will follow the steps of financial instruments. Step number 1, find the cash flows, inflows, outflows, everything. Step number 2, fair value. You will compute the fair value. Why compute? Remember, whenever there's a relationship, we have to compute the fair value. Compute means present value of future cash flow at EIR. So whatever the future cash flow are there, discount at market rate of interest, you will get some value. This is the fair value of financial liability. You took a loan of 50 lakhs. The liability value is only 37.38 lakhs. Some difference will arise. Step number 3, difference between transaction price and fair value. This difference will be treated like a DGG, government grant. Okay. Then step number 4, EI. Step number 5, LAT. Now, when you pass the entry, what to do with this DGG? The maximum students will make the mistake of saying that transferred over 5 years. That is the period of loan. Because we took the loan for 5 years now, so transfer over a period of 5 years. No, no, no. The treatment of DGG does not depend on the tenure of the loan. The treatment of DGG depends on for what purpose the loan was used. And for this, to understand this, we will also refer illustration number 5. That means if the loan was taken, let's say for example, you will have to don't check the tenure of the loan. Check for what purpose the loan funds were used. So let's say it is saying that first case, loan was used to fund the immediate relief. Loan is an immediate relief to measure the rescue enterprise. Relief measure to rescue the enterprise. That means the loan you took is an immediate relief. So whatever DGG is there, transfer to P&L on day 1 itself. Acha. What if the loan was taken to reimburse staff training expense for a period of 4 years? So transfer the DGG over a period of 4 years to profit and loss. Acha. What if the loan is to finance a depreciable asset? In that case, we have 2 treatments for DGG. First, whatever DGG is there, reduce from the cost of asset. Second, whatever DGG is there, you will book at fair value and transfer to P&L over the life of the asset. Simple. So do remember that DGG will not get transferred over the period of loan. Treatment depends on for what purpose the loan was used. Acha. Similar to this question, there was also question number 12, very same as 4 and 5. You can do in homework. But for this point, we also discussed one more question, and that was question number 5 of MTP RTP past paper. For this particular question, same. We are taking an interest-free loan. The only difference is in the above question, we took a loan at the rate 5%. Here, government is giving a loan at interest-free rate. So we took a 5 lakh loan interest-free. Okay. Now, for what purpose the loan was taken? The loan was taken to fund the purchase of equipment. Okay. Market rate is 5%. That is EIR 5%. One more information is given that there are no future performance attached to the interest-free loan. Now, ideally, the purpose of loan was to fund the equipment. So when you solve the question, see, you will solve cash flows, fair value, you will get the difference. How to treat this difference? So we check for what purpose the loan was taken. It is saying the purpose of loan was to finance the purchase of equipment. So conceptually the answer should be like this, na? That you will book a DGG and the treatment of DGG depends. Either you can reduce from the cost of the asset or you can book the DGG at fair value and transfer to P&L over the life of the asset. But what ICI has done in this question is they have given emphasis to this line. They are saying that the loan has no future condition, right? So that is why, because it is an unconditional nature of grant, we are transferring it to profit loss on day 1. Ideally, if it is conditional or unconditional, we check only when we have a non-depreciable asset. In non-depreciable, when we book the DGG at fair value, that time we say na check whether conditional or unconditional. In case of depreciable asset, so we say directly this only, na. Either book at net of cost or book at fair value and transfer the fair value to profit and loss over the period of life or over the period of depreciation, right? But anyways, I am discussing both the methods. So if this line is present in such kind of question, so you will transfer to P&L on day 1 itself. If let's say this line was missing, in that case, you will do what conceptually is to be done. Okay. So again, a similar question, step 1, step 2, step 3 was difference. We found out the difference. EIR, LAT. In day 1, you took a loan of 5 lakhs. Fair value was this much. The difference of government grant, because it is saying that no future condition attached, as per ICI, transfer it to directly to profit and loss. In this question, entries were asked for the future as also. So just look at the LAT and pass the entries. So we pass the 3 years interest entry, and in the last or final year, we will also make the repayment entry. That's it. So till here, we have completed the revision of IND AS 20. Balance, we will also cover. Okay. So conceptually, we are done. And 1-2 questions we discussed. More questions we will also discuss. Don't worry about it. Clear, guys? Perfect. Chalo. So we did the illustration number 4 and question number 5 revision. right, of Ind AS 20, and we did the concept revision. Okay, now we will move on towards the further questions also in Ind AS 20. The next question which we can revise is illustration number 15. See, I am only revising the important questions. Okay, these are those questions which cover 100% of the concepts, right? The remaining questions you can just give them a read. Okay, so now I am coming on towards illustration number 15 of your textbook. If you can see very clearly, what does it say? Very quickly I will revise it. It says we have received 2 grants of rupees 1 lakh each. That means we have received the money for 2 grants. For the first grant, it says that we received the grant for a cleaning river project. No steps have been taken till the year end. Should we record the grant? So what answer was given in the book? If you remember, there can be alternative solution to this. If you feel that 1 lakh received had no conditions attached, it will be treated like an unconditional grant, and we will transfer the whole amount in PNL on day 1 itself. But if you feel that undertaking steps were important, in that case you will not recognize any grant because no steps have been taken. This was the first point. Second point says that you received the remaining 1 lakh for the new equipment. When you receive the grant for a new depreciable asset, we have 2 methods. Either you can net off the cost of the asset, or second is you can record the PP and DGG both at fair value and transfer the DGG to profit loss over the ratio of depreciation. Simple. Acha. There was one third point also. I will just give an overview of this. Some floods happened in your company due to which you suffered some losses. Government announced a scheme where they will compensate you for the losses. But for that you have to submit an application. Okay, before 30th June. They are clearly saying that in the current year, you have not submitted the application. Okay, that is in the 11-12. Till now, you have not submitted the application. So till that time you did not submit the application, you cannot recognize the government grant. In the next year, if you submit the application, in that case in the next year you can recognize the government grant. But in the current year you cannot recognize. Simple. So these were the 3 cases. A good question. Okay. Acha. Illustration number 16, just refer it once. Illustration number 17 we can do. It is a good question. Okay. What does it say? It says that a company receives 30,000 ka grant. When did it receive? It received on 31st March 11. Okay. The grant is towards the cost of training. That means you have received this grant to reimburse the training cost. The training will last for 18 months. Okay. From 1st April 11. That means whatever grant you received, ideally you should book the grant in it within a period of 18 months. Okay. But extra information also given. Actual cost of training incurred in 11-12 was 50 and in 12-13 was 25,000. Okay. Whenever you receive a grant, there are 2 ways of recording the grant. Either you can record in the ratio of months. That is, let's say for example, the training went on for 18 months. So you can bifurcate the grant into 18 months. That is book in the current year. Suppose there were 12 months. So you will book 12 months grant in the current year, remaining 6 months grant in the next year. Or you can also book the grant in the ratio of expense. Let's say you incurred expense of 50,000 in the current year and 25,000 in the next year. So you will book in this ratio. 50:25 ka ratio you will remove, and whatever is the amount as per this ratio, you will book some in current year and some in the next year. Coincidentally, in this question, even if you take the months ratio or even if you take the expense ratio, the answer is coming same. Okay, but do remember that part. So in case you remember, wait, I will show you that part. Here it is. See, so if you take, let's say you received the money on the previous year last day. Okay, but grant is not to be recorded. Grant is not to be booked on this day. You will start booking in profit and loss from the next year onwards. Okay, so either you can take the ratio of months. 12 months fall in the current year, 6 months fall in the next year. So you will either you can take the ratio of months through which you can say 20,000 you will book in the next year and 10,000 you will book after that year. Okay, or you can take the ratio of expense also. In that also it will be the same. Also in this case I have also given the balance sheet extracts to you. How to show the extract? When you receive the grant, that was the last day of the year, you will not record anything in profit and loss because profit and loss recording will start from the next year. So this whole 30,000 received will be transferred to balance sheet liability side, but give the bifurcation also, non-current and current. Whatever you will write off in the next year will be current, remaining will be non-current. Okay, then in the next year you will transfer out of 30,000, 20,000 will be transferred to profit and loss. Out of 30,000, 20,000 will be transferred to profit and loss. So book the expense, book the income. 2 ways of showing it. Either show expense and income separately or either show net of. It is fine. In balance sheet, only 10,000 balance will be left, which will get write off in the next year. So we show in the current account, current part. In the next further year, this 10,000 again will get booked in profit and loss. So either show separately or you can show net off. In balance sheet, nothing will remain. Okay, do remember that part. This was illustration number 17. Now a very good question, that is illustration number 18. Do remember that my revision is only for your reference. Still, you have to write and practice all the important questions which I am marking you. See, through this revision video, you're also getting to know which are the important questions which cover all the concepts. On the last day, you won't be able to revise all the concept, all the questions, but at least you can revise what I'm marking for you now. So this is a very good question out of it. What does it say? It says that we receive a grant of 60,000. It is receivable, okay? But out of this, 40,000 you will receive in year 1, 10,000 you will receive in year 2 and year 3 each. So full 60,000 payment you are not receiving on first day. Anyways, then the cost is given. In the first year, you will incur a recruitment cost of 30,000 and the wage bill is going to be 1 lakh rising by 10,000 each year. See, so that is the grant is 60,000 receivable like this. Cost is given. That means the grant which is there, you will book in the ratio of cost. So recruitment cost is a one-time cost incurred only in the first year. Wage bill is incurred every year. So this is total cost year wise. Okay. So whatever is the grant, you will book in the ratio of this cost, in the ratio of this expense. Okay. Now there are two cases here. The first case says that there is a reasonable assurance that you will comply with the condition and that the grant will be received. If there is a reasonable assurance, do remember that when there is a reasonable assurance that you will comply with the conditions and when there is a reasonable assurance that you will receive the grant, you will book the full 60,000 on day 1 itself in DGG. So what I did was, because I received 40,000 cash, remaining 20,000 receivable, I booked the full balance in DGG. And this 60,000 will be transferred to PNL in the ratio of expense. So this ratio was there. So if you prepare a table, 60,000 opening balance, you transfer to PNL this much, closing is this much. Then accordingly, you will keep on transferring and show this balance. Acha. The interesting case was case number B, where it is said that there is no reasonable assurance that grant will be received. If there is no reasonable assurance, what to do? Just remember two things. First, if there is no reasonable assurance that you will receive the grant, you will book the DGG as per cash basis. Whatever cash you receive in the respective year, only that amount will be booked in DGG. First thing. Second thing, when you compute how much to transfer to PNL, that won't change in case A or case B. That means when you compute how much DGG to transfer to PNL, don't take the ratio of 40,000 into 130 by 360. Here you will still take 60,000. That means whether the grant is reasonably assured to be received or not will only change the amount of DGG. The balance of DGG getting transferred to profit loss won't change. This calculation will be the same in case A or case B, right? So if you see the table, only the DGG opening will change. Transfer to PNL is still the same like case A. Closing will change. In the next year, this closing will become opening. And can I say in the next year you will receive more 10,000. So that will increase the balance of DGG. Okay. Then transfer to PNL won't change this. Then this closing will become opening. In third year, you will receive further 10,000. So the balance of DGG opening will increase. This is only happening in case B. In case A, because we booked directly 60,000 on first day, then there was no need to add on in the respective next years. Okay. Don't worry, I will upload this board notes on a Telegram also. Link is in the description. You can join the Telegram and download the notes also. Okay, don't worry about it. So this was illustration number 18. Then we have question number 1, a very good question. What does it say? We can see, quickly have a look at it. A Limited receive 1 acre of land. Once you receive a land for free, that is a non-monetary grant. And land is a non-depreciable asset. So you have two methods, either recorded nominal value or recorded fair value. If you recorded fair value, how will you transfer DGG to profit and loss? Because it is a land, it is non-depreciable asset. So you will have to check the conditions. If it is a conditional grant, you will book the DGG in profit and loss over the period of conditions. If it is unconditional, you will transfer to profit and loss on day 1. Okay, next point. If you took a loan at a concessional rate, okay, what for a plant, you took the loan at a concessional rate for a plant. That is, the purpose of loan is to buy the plant at a concession rate, right? So in that case, whatever difference is there between fair value of loan and TP will be DGG. What to do with this DGG? Because it was taken for a plant, either net off from the cost of plant, or you can record DGG at fair value and transfer the DGG to profit loss over the life of the asset. Okay, next point. You receive 25 lakhs for immediate relief. Transfer it to PNL immediately. Next point, fourth. You receive 10 lakhs for purchase of machinery costing 80 lakhs. That means you are getting a monetary grant for a depreciable asset. Can I say it is same? Either net off from the cost or book at fair value and transfer to PNL over the life of depreciation. Okay. Fifth point is you are receiving a 25 lakh grant for research. The research will carry on for 2 years. That means they are reimbursing expense of 2 years. So transfer the DGG to profit loss over a period of 2 years. Simple, right? Done. Question number 2, you can just give a read. Question number 3 is very important. It is a good question. Let me tell you what is happening. In short, I will tell you. Government has announced a scheme where they will give an interest-free loan for 50% cost of the plant. Okay. So, but there are some conditions. If you violate the conditions, it becomes repayable. So whatever loan you take, you will have to repay the loan immediately if you violate it. And along with the amount of loan, you will also have to repay a penalty of 10 lakhs. Okay. Okay. So company took a loan of 25 lakhs. Marketed was 12%, but company got this 25 lakhs for 0%. Okay. Now, and they are saying that whatever DGG you get, because you are taking an interest-free loan now, so some difference will arise in fair value of financial liability and transaction price. That difference will be DGG. What to do with that DGG? So ideally, because it was taken for a plant, it was taken for a depreciable asset. Either you can reduce from the cost of the asset, or you can book the DGG at fair value and transfer to PNL over the ratio of depreciation. It is saying that company choose the second method, that is booking the DGG at fair value and transfer into PNL in the ratio of depreciation. Okay. So this is going to happen. But what happened was, the loan was of 5 years. After the second year itself, company violated the conditions and the loan has become repayable. Now give the accounting. How to do the accounting for this question? It is very simple. Just remember that bifurcate this question into 2 parts. First, when you take the loan, the day 1 accounting of loan. So cash flow, fair value of FL, because there's a relationship government is giving you for interest free, you will find the fair value, compute the fair value. Difference between TP and fair value will be transferred to DGG. Okay. What to do with this DGG? Company follows of writing this off over the period of depreciation, that is 5 years. Okay. EIR is 12%. LAT. LAT prepare only for 2 years, because after 2 years you are going to refund. Okay. Also prepare one extra working note of DGG. What is the balance of DGG after 2 years? So you were supposed to transfer this whole balance in equally over 5 years. So after 2 years, you must transfer this much balance. So this is the balance of DGG after 2 years. Okay. Now what to do? So first I pass the entries for the initial 2 years, the basic entries, booking of the loan, charging interest, writing this off. But the main entry comes is on the second year end, that is the journal entry for refund. For refund, what will you do? You have to give 2 amounts as refund. One is the loan amount and one is the penalty amount. What to do with this? It is simple. When you are refunding the loan, I pass separate entries for this. Whatever FL is there on the date of refund, reverse it. Whatever DGs is there on the date of refund, reverse it. Difference transfer to profit and loss. And whatever penalty you are paying, transfer to profit and loss immediately. Simple. Simple, guys? Yes, sir. This was question number 3. A very good question. Please do practice it. Then there was question number 4. You can just give it a read. I will just give an overview of this. It says that, I explained this with the help of example in case you remember. It says that if you are depreciating over 5 years, you will transfer the DGG over 5 years. Simple. But what if there is any impairment in a particular year? So because of impairment, can I say your expense increase in that year? Because in that year, you will also depreciate and you will also book an impairment loss. So when you book an impairment loss, the amount that will be transferred from DGG to P&L will also increase in that particular year. So likewise, in the first case, you were booking depreciation equally. So you were transferring DGG to profit loss equally. But in a particular year, if you book an extra impairment loss in addition to depreciation, in that particular year, DGG will also get transferred to profit loss little extra. Simple. But there were 2 instances. In first case, there were no further condition attached. It was mentioned. So you will do this. Once you book the impairment loss in that particular year, extra amount will get transferred to profit loss from DGG. But there was second case also. Would your answer be different if there are further condition attached beyond the construction of factory? In this second solution, they said that directly don't do this. Directly, just because of impairment loss, you will not increase the transfer of DGG to profit and loss. You will also have to check what are the further conditions. So here it is mentioned that if there are further conditions attached beyond construction, it may not be appropriate to release an amount of DGG to compensate for the impairment write-down. In that case, you would also have to assess those further conditions. Okay, so just give it a read. Okay. Then there was 17 words done. Okay, question number 5 you already revised. Nothing is left. Okay. Apart from this, there is also one illustration number 11, which is very similar to question number 1 of MTP RTP. You can also give this a read. Okay. So this finally completes the revision of IND AS 20. I hope you like the revision where we revised all the concepts along with the questions. remaining questions you can just give them a read. If you are through with the concepts and these questions, the remaining questions are also very manageable. Okay, I hope you like it. Please do like the video in case you like it. Also share it with your friends and subscribe to the channel. And also if you want the board notes available on my Telegram, you can download it. Okay, also if anyone is there who has not bought the lectures, my lectures of 100% English batch are available on bbvirtuals.com. In case if you feel the need for it, you can go and buy it. Okay, if you have already bought it, very good job, you're doing a good job. Okay, so thank you so much everyone. Bye bye everyone, take care, see you all, bye bye.